Hello Gappers, this is Scott and this is the Gap Wrap for Wednesday, February 10th. So yesterday we looked at the futures, today we'll look at the ETFs, and I did not take today's gaps. They were small and in mixed zones and mixed directions. For most of the, if not all of the ETFs, we had small down gaps, but as you remember last night's video I talked about the daily dojis. You can see there was only 9 cents difference between yesterday's close and yesterday's open, so when we opened down 15 cents today, I think it was actually 17 cents down. What did we open? 107.05. So we opened down 17 cents in the UOL zone. Based upon market conditions, nothing inspiring there. Basically a dead break-even strategy. Based upon patterns, lots of risk. Whenever you see profit factor less than, say, 0.7 or 0.75, then that should be a big flag to you. That tells you historically there's been substantial losses in based upon current closing patterns that are in play. So this identifies when there are risk patterns in play, and historically this is less than 50-50 and a big money loser. Based upon seasonality, same scenario, totally different filters, but also showing a very risky setup. So two big strikes and nothing there positive. See, looking at diamonds, the diamonds opened at 100.55 in the UCO zone. It was not a doji, a slight down zone. This is normally a pretty good zone, but you see these numbers are very uninspiring, showing lots of risk based upon patterns. Also, Qs opened at 43.10 in the DCL zone. That's because open to close was down yesterday, so a different direction, open to close. That's always another risk factor, and even though it was a 1 cent gap, it was basically a flat open. Still, look at the numbers here. Not good. Profit factor 0.69, 0.52 over here. Why are the market condition numbers so much worse here than some of these other ones? Well, it's a different market, different amount of data, different direction. So these are D-based zones. And even market conditions will vary among the indices sometimes as we hit certain inflection points. And I think that's what's going on here also. So they can vary. And let's see, the Russell opened at 59.31 in the UOL zone. Small sample size, less than 10 at least historically. Terrible returns for pattern seasonality. Folks, those are really bad numbers. Okay, now the futures, some of those gapped up. I'm not going to look at those right now. Some gapped up, but they also showed meager results for the most part, and they were small gaps. And let me show you my pre-market comments how I added this all up. So win rates, profit factors all over the map due to mixed prior day directions, opening zones, open and close directions, etc. Let's see, prior daily doji. Not only is that a risk factor for gap fading in general because it shows market decision, but also it makes the gap guides less reliable, less helpful, because if a given market closes a little bit higher, a little bit lower, then it's going to change the setup and therefore the probabilities, which is common sense. Put gaps up, we have pivot straddles. So bottom line, it wasn't a whole lot going for this for a gap down at all. And the only one I mentioned was that if the Dow indices gapped up, they were not dojis. I would have considered fading. I was actually thinking about fading the YM because the numbers are so weak to the downside. In fact, I'm going to talk about that a little bit more. Those numbers I just showed you, even though you don't know it, I know behind the scenes the numbers that are used to generate those low, what show those low win rates and profit factors pretty consistently for down gaps based upon patterns. Okay, let me go back to it just so you know exactly what I'm talking about. These numbers were very weak, right, based upon patterns. Let's see, that wasn't too bad there, but up here, 0.41. The reason some of these numbers were so terrible is we had multiple patterns. Most of my patterns are organized in a way so that they're not there's not a lot of overlap between them. I've identified the best patterns for different categories of patterns that I watch in terms of being risky or not. But what happened today was a really unusual situation where I think in the S&P I had 4 or 5. In fact, all of my markets I believe had at least 4 risk patterns firing. So with that information in hand, showing terrible profit factors for the most part in these various zones, I had 2 of the 3 conditions in play in my mind to be looking to the short side. I showed a potential bias, a likely weakness after the open because there were so many risk patterns for buying a down gap. That tells me, just common sense again, that the market, if it's not likely to fill without hitting a 30% stop, below it, that means it may be likely to go down. So let me show you how I traded today. Had a really nice day trade, if I may say so. So with a directional bias based upon the gap guides being so weak to the downside, and seeing confluence up here from the price guides, which I didn't show you, but this came straight off the price guides. Multiple layers of potential resistance. We have the daily pivot, prior gap fill, and several other resistance levels right there. When we gapped down this morning, the only thing for me left to check was to watch the price action. Let me expand this. And with a directional bias to the downside based upon the gap guides, with confluence just above, major confluence just above, a gap down, and then thirdly, my last check mark for me, or last consideration, was price rallied, but the internals I watch are trend was pushing up higher, that's bearish. Ticks were solidly negative after the open. You can't see that here, but you'll have to trust me or check your own charts. They were solidly negative here after the open. Has two internals that were not supporting price action. Also watch advanced decline ratio. That was also very weak. And the AMEX select sectors, which I watched, the different components of the S&P were also very weak. So I had 4 different internals saying the market is weak, but price was rallying right into confluence. With a direction bias to the south side, I had to do a short. So I called out a short in the trading room extremely quickly within a minute or two after the markets open, and I faded this pink line underneath, this magenta line, which is the daily pivot. I went short at 1067.25 precisely. I used a 3-point stop, which was right here at the bottom of this confluence, and I survived that long wick right there. And then it rolled over. I got plus 1.5 points, and my target was this next confluence area. I didn't want to be greedy, so I set up 1 point in front of the confluence. So I went to 1059, and I nailed 8.25 points on the second half for just a sweet day trade. Again, don't want to sound like I'm bragging, but I've had my last couple of day trades have not been so good. So that one was a good one, and not much else to say about it other than this confluence held. We talked about this being a good risk to return scenario, and then all the internals were really down. I know some people did get long. I did not. I just called it a day. And let's see. You can see the market's still going. I've got a webinar starting in 40 minutes for members only, so I need to wrap things up. Looks like we're going to finish with another near doji day. So with that in mind, let's see, two dojis. My pressure is building if we end up finishing right here. You've got serious market indecision. If we can break above, certainly above yesterday's highs, you've got some room to the upside tomorrow. If we break beneath today's lows tomorrow, then it's downside, but again, going to be a little bit riskier of a setup, and I'll have to defer to the gap guide. So nothing really stands out to me right there. Just be careful. These dojis are telling you the market is confused and undecided, and when it does make up its mind, it's probably going to bust a move, as they say. And there you go. That is the Gap Wrap for Wednesday, February 10th.